Yeah, everybody. Hope you had a wonderful Mother's Day weekend, and you treat your moms all right, and your spouse is all right. Again, guys, I talk about this over and over and over. The 5Q tape breakdown. Um, if you're not doing the 15-minute drill, which you should be doing, but if you're not, at least do this every other week. It takes 10, 15 minutes, and it will greatly increase your abilities. Learn from other people's successes and learn from other people's mistakes. So thanks, John, for sending in this article and you guys can all find it online if you want to get it later on. But is the economy really as good as the government claims? How many of you think the economy is as good as the government claims? Well, this gentleman makes a good case that it's not. For one, Congress is continuing to spend like drunken sailors, and I'll go all the way through down to here where the summary of this particular one is by pumping the massive 11.1 trillion in economic stimulus since 2020 to individuals, companies, healthcare institutions, state and local governments. This new money and excess savings have certainly kept the economy afloat. Guys, if you pump $11 trillion into anything, is it gonna make that thing look pretty darn good for a while? But to be cynical, at some point the deficit spending has to end, and to be cynical, it'll probably end right after this year's presidential elections, and then the hangover begins. So, we're not going to see that kind of input into the economy again, ever, I hope. Number two, consumers are highly reliant on debt. Consumer spending represents 70% of U.S. economic growth, and consumers have already spent their excess savings from the government. So the stimulus spending money is gone. Credit card balances are at record highs. Consumers are hitting their credit card limits at a pace not seen since 2008. Credit card debt is officially rising faster than it was before 2008. Personal savings rates have dropped from 5.3% last summer to 3.8%, so they're spending their savings as well. Historically, as consumer debt rises, we've seen a dramatic drop in consumer spending. Duh. Because eventually what? They hit that top of their credit card and they can't go any further. Total revolving debt is now at 1.3 trillion, up from 960 billion. Interest rates on credit cards are near 25% annually. For the first time in history, interest rate payments on non-mortgage debt are equivalent. For the first time in history, interest rate payments on non-mortgage debt are equivalent to interest rates on mortgage debt. While the U.S. consumer remains resilient, Deutsche Bank points out that the credit card delinquencies are at their highest rate since 12 years. The rate of credit card delinquencies has only been this high 3 times before, since 1947. The last two contractions coincide with 2008 and 2020 pandemic. High interest rates plus a high debt environment are strong headwinds to overcome. And the last is unemployment rate is at historic lows. You'd think that that'd be a good thing, but it's not. It's not a good thing. Why? It is a good thing, but it notes that what? We only have one direction to go, which is what? Down. So these are things that are problematic for the economy. And how does that look for the market? Well, in the last 30 years, including the last 3 recessions, the PE of the S&P 500 index has never, all caps, never been so historically out of alignment. So the PE versus the price, look at how it normally stayed within reason, right? What's happened over the since 2010, this unbelievable bull market. And guys, anytime there's an unbelievable bull market, anytime this was, again, we have to use the power of exponential numbers here, but this was extremely, from 1995 to 2000 was a unbelievable bull market. What happens after unbelievable bull markets? From 2022 to 2027, unbelievable bull market. And guys, how do those bull markets compare to this bull market? And after every bull market, what has to happen? The S&P 500 dividend has never been, look at how low, since 2000. I shouldn't say never, but it's in the danger territory now, with saying that the dividend is so much lower than actual S&P 500 price, another measurement of the market. Almost 30 years, the difference between stock market price and its 200-day moving average has never been greater. Look at how big a difference it is between the 200-day moving average and the actual price. Total value of publicly traded stocks as compared to GDP. This is the mean. How far away from the mean are we right now? Holy cow, that's crazy. So guys, I'm just saying what? I've talked about this, and I haven't talked about this for a long time, but right now, Doesn't mean we know when the market's going to correct, but right now we're in that shed, that wood shed in the backyard with the 50 years of tinder dry newspapers and a gas can in that shed. What's it going to take to blow this thing up? A lot or not so much? So just be aware of that. And we're going to talk a little bit more about options here in a second. But Jerry has some great additional information that maybe you could use if you realize that your client's assets are in that shed with 50 years of tinder dry newspaper.
Absolutely. Thanks, Mike. Hey guys, good morning. One of the things Mike the other day, he had put up this fantastic chart, and I know Dan's been calling a lot of people.
Let me get that.
Can you hear me?
Yeah, there we go. Perfect. I have it.
Yeah. Here we go. Here's the chart actually here too as well. And when you walk through this, it's such. We were just discussing this too the other day. It's such a no-brainer, to be able to have a tool like we do with fixed index annuities. Whether it be the trigger method, whether it be the high 10% S&P cap, and we have that guaranteed S&P cap right now too as well. And then you look at the yellow line on here, which is the 40% participation rate. We got products right now that are between 40 and even like 75% if you take a 2-year point to point on that par rate. I have seen as high as 55 on the 1 year. But, when you're looking at it here and you look at the S&P 500 with no fee, and then you have the S&P 500 with the fee, and we're looking since 2000, it's mind-blowing, actually, to be able to go ahead and see that they're actually beating it. And we were just kind of discussing, the most important thing is, even within the fiduciary duty, is to at least show these options to clients, right? At least at the bottom line is if you show these to people and they say no, well, the beautiful thing is if accounts go backwards or things like that happen, you did your duty and showed clients or prospects the fixed index annuity. Everybody in your portfolio should have seen this. I think it's no brainer when they look at it, but you may have some people that say, hey, you know what, that's not for me, but at least you absolve yourself from that risk of not being a fiduciary and not doing the right thing when you go ahead and you show them the fixed index annuity. I just flat out, when I look at that, I say, why wouldn't, when over a 24-year period, I have a tool that can't lose any money, and over that 20-year period, when you get into retirement, it might be 25 years. Yeah, go ahead.
I'm going to go back here too, Jerry. Guys, and we're looking at what 24 guys. We're looking at a 24-year period that the market did well or did poorly. W is well, P is poorly. Over the last 24 years, would most people be really happy to have been in the market? W for well, P for poorly. Here to here, well or poorly? I only got one answer here. Well or poorly, guys? Thanks, Andre. Thanks, Dale.
They would have been happy.
Okay, so we're not saying this is a horrible time period here that these FIAs would have done well. It was compared to an unbelievable run up by the stock market. Sorry, Jerry.
No, that's actually a great point, Mike, because it was a great run and it was a great period in there. So that's where we want to make sure, everybody should be evaluating where they're at. We have lots of guys that come from different walks of lives, and I get there's a lot of reasons why maybe you don't want to rock the boat or what have you. I have some guys that maybe you're thinking to yourself, well, I have a bunch of people, maybe they have mutual funds or in their managed money or something like that, and things are going pretty good. So they're happy. So I don't want to go back and bug them or talk about stuff with them or kind of rock the boat a little bit. Or life's going pretty smooth for me. The thing I would tell you is you want to go back and show them, because first of all, statistics show that the number one reason why clients leave their advisor, it isn't because of rates of return or losing money or bugging them. It's because of lack of contact. That's the first thing. So the more you're in touch with your clients and they know that you're there for them, you're talking to them, you're letting them know what things are going, whether it's going up or down, the communication that you're having with people is one of the things there's a lot of items, right? There's multiple lines of business. There's a lot of things that go into it. I know Mike did a call on that once, but I know it stuck out to me that one of them is communicating with people and going back and talking with them. So like we're talking about it, you have the duty to show them, but then why wouldn't you here? And then I was talking to one of the advisors, and we're kind of ferret. I always like to ferret out what are some legitimate reasons that we have as advisors where we may not want to go back and show an FIA to someone. One of them I just handled, which was, maybe I don't want to rock the boat, which I would tell you, you do want to go back. You want to go talk to them, visit with them. Ignoring a client and not talking to them is a bad thing. We've established that. That's bad because that's the number one reason why people leave their advisors. Another reason we're talking about is...
Can I jump in there for a second?
Yeah.
You remember your second reason here? Yeah, I just read in the Investment News magazine, which is pro insurance or pro securities. It's pro securities. It's pro registered investment advisor. I mean, that's their whole point. But they pointed out that, and Jerry, you know this, are people selling less FIAs, or was it record number of FIAs sold last year?
It's record
numbers. Record numbers of FIAs. So the point is that if you don't want to rock the boat and go back to talk to your client, you're in grave danger of what, guys? Somebody else rocking your boat and talking to your client. So at least get there first. Sorry about that. What was your number two reason? I interrupted you.
No, 100%. No, that's a great point, Mike. We're flowing off each other good here today. I would say the other one here, this was a big one I've talked to guys is I understand when you build up a book of securities and you have specifically managed money and you got your trail, and it's nice because it's nice to be able to wake up Jan 1st. You have that there. There's kind of that steady money that's kind of coming in, and that's for the growth part of the portfolio. And the growth part of the portfolio is great. It's great to be able to have that. But what I challenge you to do is, and I've talked to some people is that, do you have all your clients in managed money sitting there? How many of your clients don't have any fixed index annuities? I mean, we should be looking, especially people that are retired should be 40, 50% and up. But I get it because they say, well, they're happy. They're not bugging about it. And I'm making this trail off of it. I'm getting my 1% trail. And that makes sense because you got that money that's coming in every year off the trail. That's that steady dollars. I don't really want to cannibalize that. Okay. And I say that that's valid, right? You don't want to cannibalize that. Well, here's where I would tell you get an improvement on the fixed index annuity if that's a concern is. Most products now are going to give you a 1% trail. So you're not going to lose that trail if you really want to take that payment structure, if that's important to you. But most importantly, if I shift this portion over to safety for the client and give them the safety, guess what you're getting for safety and your income too as well. The nice thing about the fixed index annuity, not only does it protect your client from losing their asset and their income, but for you, you don't have to worry about the account going backwards because of losses. And so you don't have to worry about your trail going backwards. That's a big advantage that a lot of people don't think of when with a fixed index annuity. Not only does it save the client and protect them for their retirement and their future, but it's also protecting your trail as well, because there's only one way that the trail can go, and that's stay flat or go up. And so you're not going to have to worry about if there's if you have a 30% decline in the market, then your trails on your market investments goes down by 30%. But obviously, if that same 30%, if you have 40, 50% in a fixed index annuity and you're catching a trail on that, you don't have to worry about that going backwards. So you're not going to lose that income as well. And then there's kind of one other idea, one last point to that I like to bring up, which is with your fixed index annuity, when you come back, who likes to give out good news? I know I do. I like to be able to give people good news. And sometimes it's great to be able to have that when you go back and visit with people. It's always nice. Your clients love it when you come to them and you have a great way to, save them money, or you got a really great idea for them that's going to do some good things for them financially. How about this? If I come back and a client sitting, in most of their portfolios and manage money, and they're getting that, maybe 1 to 1.25 fee or 75 basis points, whatever you're charging them. If you come back and you're able to position them into this product, which has obviously done good the last 20 years, 24 years, and you can slide in 40, 50, 60% into the fixed index annuity, you're not losing your trail. But also, guess what you did? If I moved them to a 50-50 portfolio, 50% out of their managed money, what did I just do? I just cut their fees on their accounts in half, absolutely in half, because the managed money fee comes out of their portfolio. So that's directly affecting their account on an annual basis. But if I move it in the FIA, now we eliminated the fees on 50% of the account, and we just gave them a 50% savings on their fees. That's thrilling. I mean, that's one of the points I always talk about, guys. When you're bringing on brand new money and brand new clients, if you're using that 50-50 portfolio when you bring on brand new clients, you know right off the get-go, if you're running into someone that's 100% in managed money or securities, that that you're saving them 50% in fees. So that's one of the conversations. I just think that's something to think about. If you don't have, if you haven't gone through and made sure that everybody in your portfolio has a portion in fixed index annuities, at the very least, you should show it to them. You can't make people do things they don't want to do. But I think that there's a pretty good argument when you look at,
well, you only gave half the argument there, Jerry, on that one.
Did I miss part of it?
So you said, so you said that you'd reduce the client's fee by half on a 50-50, or even more than that if you went to a 40-60-64, or a 30-70. But what happened to the advisor's income? Because the last thing I want to do is save my client fees, and then I get screwed. Well, but what if you could save your client fees, give them a portfolio over the last 24 years that's blown everything else away, and did what to your own income?
Well, you insure your own income too as well. So your own income, when you have your money in that trail option there, you're going to go ahead and you're going to be able to save yourself. You don't have to worry about your money going backwards, because if you're getting a 1% trail and then you don't have to worry about your trail going backwards if the market goes, then you're saving yourself. Because you think about it, if the market drops by 30%.
Well, and even if the market didn't drop by 30%, though, have they hurt themselves? If they moved the money over into, they moved half of it from a managed money account
trail
and they moved it to an FIA with a trail, did they hurt their income at all?
No, you're even, Steven.
But wait a second then. You're saying there's a 1% trail, but doesn't that hurt the client? And you're saying the client isn't charged a fee. Well, guys, look at this chart. Is the fee included? Is the commission included in these? Everybody answer this. Is the commission included in this FIA performance? Yes or no? Yes, everybody's saying yes. It is. It is included. So the fact is, you really are, if you went to a 50-50 portfolio, cutting the client's fee by half, but you're still getting your 1% trail. So you haven't, guys, you get the same amount of money. They cut their fees in half. And have you hurt their portfolio at all? My God, please, please, please. If you're a financial advisor, if I was on the nightly at primetime TV and I went, Jerry talked about this chart or I talked about this chart, how many people would be picking up the 800 number and calling it? Cut your fees in half, better rate of return over the last 24 years. Where's the downside, guys? There is a downside. What's the downside, guys? What's the downside to moving your client's money 50% into an FIA? At least a downside as compared to what other advisors, non-5Q trained advisors say. You've just done what to half the money? You locked it up, right? With the money, yeah, you locked it up. But if you do the FIA presentation, how many times will the client tell you that an FIA is more liquid than a money manager? Not a money market, a money manager. How many times will a client tell you, if you do the FIA presentation, will tell you that an FIA is more liquid? Not you telling them. They will tell you that an FIA is more liquid than your money manager. It already says every time, but how many times during that FIA presentation? How many times do I have them tell me that an FIA is more liquid during good times, is more liquid during bad times, is more liquid always? Not by a little, but by a lot. I do not tell them that. I don't tell them it's more liquid during good times. I don't tell them it's more liquid during bad times. I don't tell them it's more liquid by a lot. They tell me over and over and over. So higher return, less fees, more liquid. So, and guys, if you're scratching your head saying, I don't want, what? Go and watch the FIA presentation, at least the liquidity portion. In fact, many of you guys, when you came out to training, that's the one thing at training that everybody who's an RIA, I promise them that I'm going to get them to tell me that FIAs with a 7-year or a 10-year surrender charge is more liquid than an FIA. And every single person that came onto this system that went through that training, at that training said, yes, you're right. The client would say it is more liquid than an FIA with a 10-year surrender charge is more liquid than a money manager. And if you don't know that script, guys, you're missing a huge chunk of the value of what we offer here. So I interrupted you again, Jerry. Were you winding it up, or did I cut you off?
No, we're winding it up. No, it's all great. It's all great points. And guys, if you want to chat about this, I would give me a call. I'm happy to walk through this with you. And then we have a number of different products that can fit in this. We got the 10% cap, we got the 9% trigger, we got the 40% participation rate, even better than that. So give me a call, and if you want to put this theory to test, let's chat about it here, because this is great evidence here, and there's some great points. And we can talk about which products have the trail if you want to get in and put some in a trail there too as well. But most importantly, let's get out and make sure your clients hear about this from you instead of one of your competitors. That's what I got, Mike.
Thanks, Jerry. And that actually kind of tied into the thing I wanted to talk about already this week. So this is a public service announcement. You guys are independent advisors. You're going to do what you're going to do. You know what's best for your client. But I do want to go through what's happening around you, and you cannot be ignorant to what's happening around you in this environment. There are two approaches to investing: active investing and index investing. We just gave you a great analysis of passive investing and how FI is compared to passive investing. But the question is, but my money manager is awesome. He's an active manager, and he can beat the index investing. Anybody that told me that their money manager could beat the index investing, what would I tell them? Oh, wait, somebody brought up, hey, guys, Bob brought up, well, but wait a second. I thought you always said that FIAs were a replacement for bonds. I thought you said FIAs were a replacement for bonds. Well, geez, you're right, Bob. It is, because what person in their right mind would have any money for their guaranteed money in bonds when this is how the FIA performed? Also, if I was using it for bond replacement, which is a great idea, would I be going with a 30% bonds and 70% stocks, or should I go with a 70% bonds using the FIA as the bond portfolio and 30% stocks? I don't think you should have 100% of your money in FIAs. I personally don't have 100% of my own money in FIAs. I have half of my personal money in FIAs. And actually, I've moved more than half as of late because of the 10% cap. I'm using this as much as I could possibly use. Does that make sense, Bob? So anybody who says their active portfolio can beat index investing, it's not. It cannot happen. See, there's nothing either good or bad about but thinking makes it so. So what I mean by that is I'm not saying active investing is bad, but right now, what's growing faster, the amount of money in passive investments or in active investments? Every single article that 90% of the articles that your clients are reading are saying, yeah, you should go get an active manager, or are they saying you're crazy to pay fees when it comes to active management when passive is better? How much is passive kicking butt on money assets under management? Which one is growing? Look, this is where, in 1995, this is where passive investing is. Now where is it? And what's happening every single day? Assets of December 31st, 2003 outflows. Active management, 576 million. This is our millions, so that's in billions outflows. Active, net increase. Total active, negative 447. Passive, positive. Passive, positive. Total passive. What's happening to active? Is it going to get easier or harder to sell your money management as compared to passive investing? And why is this happening? Why is everybody moving to passive? Why? Well, here, this gives a good example of why. This is looking at the top quartile, the 25 best active managers who regularly beat their passive benchmarks. The top 25% of managers who regularly beat the benchmarks. Look at back in 2000, 2003, what percentage of them were beating, of active managers were beating their active benchmarks? But what's happened ever since? It's gotten what? Here's the 0%. This is the average. This is the top 25. This is the average active manager, top 25. What's happened to both the difference between the active and the average and the percentage of them that are beating the S&P 500 on a yearly basis? Why? It's trending what? Down. Why is it trending down, guys? Think about it. Why is it becoming harder and harder for active managers to beat the S&P 500? Lower fees, exactly right, Mark. Why else? With the amount of computer power, algorithms, AI, et cetera, how many companies can get an edge on another company, let alone the S&P 500? Is that easy to do, or is it getting harder and harder and harder to do? That's what's happening. Average annual, remember, how many hedge funds when Warren Buffett had the bet with them, how many hedge funds, supposed to be the best manager in the world, people will pay 20%. They'll pay 20% to be in a hedge fund. And this is not including the fees. But when somebody's the biggest investors in the world will pay up 20% to be in a hedge fund, you'd think that those were the best money managers in the world, right? How many of them beat the S&P 500? How many hedge funds beat the S&P 500? None. Zero. Zippo. That's the top 10 biggest managers. How many actively managed mutual funds regularly beat the market? Not one of the 2,132 they looked at. The study examined 2,132 actively managed funds, excluded only those focused was on a narrow market segment, like all of it in energy, all of it in banks, all of it in whatever, but that's high risk. So every actively managed fund that wasn't in a sector fund, the S&P 500 indices analysts calculated the performance of all funds from June 2017 to June 2022, 5 years. They broke it down year by year so that each fund, they knew what percentage of it earned in 2017 and how much it earned in 2018, et cetera. Then they looked for the regularity of the performance. Are they top performer every single year, or was it a one-off? To start with, they picked the top 25% best performing funds for the year 2017-18. Afterwards, they examined how many of those funds stayed in the top quarter of performers in each of the next 4 years. Not a single one made it. So the top 25% of all actively managed funds, how many of them after 5 years stayed above the S&P 500? Not one out of 2,132 funds. Why? Why? Because in order to beat the market, you have to what? In order to beat the market, you have to do what? Take more risks in the market. And so when you take more risk, you get more return. But essentially, the house always wins. And the house in this case is what? The market. And the market is the S&P 500. The market will win. So anybody tell me that their money manager is going to beat the S&P 500, I'm going to tell you what. You're a big fat what? Starts with an I or an L? Active managers are getting a smaller slice of the pie. But a lot of people say, I'm going to sit here. But Mike, my money manager is doing fine. I actually made more money last year with my money manager than I did the year before, and that I did the year before that. So I'm doing just fine. Why is that occurring, guys? Because here's why. Actively managed segment is riding a bull market subsidy. That could persist until a bear market takes it away. The stock market is up 122% over the last 5 years. So if you have managed money, how much should your income be up over the last 5 years? 122%. If you're at least matching the market performance, 122%. Probably, according to all the data I just showed you, it's going to be less than that because you didn't match the market at 122%. If you have a big base of assets in the bull market, there's nothing greater. I mean, that's why your income is going up, 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 up. What does that not include? See, last year, for example, active funds grew by $12 billion. Did they really grow by $12 billion? No, we just saw that what? There's a huge outflow out of active. So then why did the amount go up? Not because money's flowing in, it's because the market went up, what? 122% over the last 5 years. Yet these assets have ballooned by $5 trillion over that time. So the fee revenue has grown by $45 billion. That's why your income went up. But it makes sense to the normal mind that you lose customers and make money. Guys, if you're making more money and losing customers, what's going to happen? The active slice of the pie is shrinking, but the pie keeps getting bigger because the accounts are going up. But what is going to happen to your income when the market falls 50%? See, eventually, we're going to have to pay the piper. So you got to be moving your clients into a 30-70, a 50-50, a 60-40. And again, we looked at that. Why? And from Kitces going through and analyzing a 4% withdrawal rate, today's stock allocation versus stock allocation at the end of 30-year retirement. Well, if you had 0 in stocks, you got a 25% chance of running out of money. You got even if you have 100% in stocks, you have a 10% chance of running out of money. But here's the thing. If you get in the green here, you start out with somewhere between 20% in stocks and 60% of stocks. You stay in the green and then move dollar cost money, average that money into stocks over the next year, then 10% the next year, 10% the next year, 10% the next year. The best likelihood of not running out of money, the 95% chance of not running out of money, is starting out with 30% in stocks now and 70% in stocks down the road. That means instead of having a 10% chance of running out of money, you have a 5% chance of running out of money. That's what? That's twice. You've just cut your chance of running out of money in half. Instead of having a 10% chance, you have a 5% chance. You've just cut the amount of money, the chance, or you've just cut the chance of running out of money by half. Instead of 10% chance, you have a 5% chance. And we just looked at, you have a chance of doing how well? We get here. You cut your chance of running out of money by half, and have get rewarded for it in the long run. So guys, please listen to what Jerry said. Call him. Be combing through your portfolios, and you should be at a 30. No more than 4% in money management right now to protect your clients and to protect your own income. And you're not hurting them at all, and you're not hurting yourself at all. Make sense? Okay, so today we're going to start all over again with the 21-point checklist at the very beginning of how you run a 21-point checklist. And what we want to do during that first part of the meeting is talk about things done well, talk about they've already done all the heavy lifting. We're going to give them the third or the real world example of what we're doing here is a home inspection. Would you ever buy a home without doing a home inspection? And we're going to say that any changes that we're going to recommend are easy and simple. And we're going to ask that could they live or with or not, fix or not. They're going to tell us at the end what they want to fix and what they don't want to fix. Does that make sense? So let's go to the meeting process, the 21-point checklist meeting, and we'll go to the training video. Okay. So a couple of things. We're going to be filming the debt. So to the that's or your CYA report.
Okay.
So I've got yours here, and I'll have one here that we'll be going through.
Okay.
So the first thing I want to do is tell you that you've done many things well. And in fact, things that we would not be able to even help you with if you haven't done it. Guys, when I was making $50,000 a year, I never, ever started a meeting saying, there's many things you've done well. What did I immediately want to get into? When I was making 50 grand a year, what did I immediately want to leap right into? The fix, that's the right deal. All the things they've done wrong and how I could fix it for them. Why do we want to tell them that they've done many things well? Because people love people who tell them they've done things well. So let's start this out by having them love me. So the first thing I always start with is telling them they have done many. And guys, have they done many things well? What every single client that you want, give me some things they've done well. Any client that would come in front of you, give me some things that you know immediately, if you'd want them as a client, that they've done well. Give me some ideas of what they've done well. You know, they save money, Mark. They have money. They have money. That's right. What else? So they have money. That's right. They save. They've done great savers. What else? No debt. That's right, Gigi. No debt. So we know they've saved money. They have no debt. They have good income. So why not compliment them on that?
Done it yourself. For example, you've got great assets.
Okay.
You've built up a great income, and you've paid down your debt. So almost all of it, in fact. So those are things that I call heavy lifting. You've done all the heavy lifting. If you came to me and you hadn't done those three things, there's not really a lot I could do for you at this point, because those are things that take decades to do.
Okay.
So congrats on that. Now, the rest that we want to cover is, for example, if you ever went shopping for a home and you walked in.
So at this point, what's happened to their anxiety with me? What's happened to their resistance to me at this point by starting out that way? Hey, you've done all the heavy lifting. You're above average. It's gone down. That's right, Artie. It's gone down. So I'm relaxing them, which is where I want them to be, in a relaxed state of mind, not a defensive. Oh my God, clench your hands around your wallet because this guy's going for it. I want them to be relaxed. So does it sound like I want to move all their money right now? Does it sound like that's my premise, to move all their money right now? When I've said they're doing great. No, they don't think that that's what I'm doing at this point.
It was the perfect gourmet kitchen. It was the perfect master bedroom, and the view was unbelievable. And both you and your wife were saying, "Wow, this is the house." Would you just then go ahead and buy it, or would you get at least have a home inspection done first?
Oh, I'm sure we'd have a home inspection.
So the analogy is there. I'm saying, hey, if you buy this, you walk to this house and it's gorgeous. It's got Cambria on all the countertops, and unbelievable light fixtures. View has a sport court. This is unbelievable. Would you still do a home inspection or not? Because could there be some things, even though it looks beautiful on the outside, could there be some cracks? And I'm saying, hey, your portfolio right now is beautiful. You have low debt. You have a lot of money saved. It's wonderful. You got a luxury portfolio, but does that mean you don't want to at least do a home inspection to see if there's any cracks behind the wall, any leaks behind the wall? See the analogy that I'm making there between a home inspection and what's happening with them? On the surface, things look great. But just because things look great on the outside, with something as important as a house or something as important as a retirement, would you or would you not still do a home inspection?
So you love the house, but you want to make sure what isn't happening under the surface.
There's no foundation issues or any cracks or anything like that.
Yeah, foundation issues, electrical, plumbing, drainage, because those things could do what to a beautiful house over time?
Oh, they could ruin it.
They could ruin it. So you built a beautiful house with your great assets, income, low debt. Today we're going to be doing kind of a home inspection report on your retirement to see if there's anything under the surface that maybe could erode that over time. Does that make sense?
Yeah, that makes sense.
And these are the things that we found on our home inspection report. Now, the nice thing about them is, guess what? Simple and easy to fix.
So why am I doing that? Because does anybody like hassle? No, nobody likes hassle. So I'm saying, listen, anything that we find that needs improving would be simple and easy to fix. Now, again, what have I done again to their resistance level, their anxiety, their fear of me going for the throat? What's happened to all that? By me saying, hey, anything we do is be simple and easy to fix. You've done all the heavy lifting. You got all this stuff that's great. You've done all these good, big things, and anything we find is going to be simple and easy to fix. So their resistance goes down. They relax.
So that's the great thing. You've done all the hard work. These are simple and easy to fix. Also, with a home inspection report, are you required to do those things, or can you choose, maybe we'll do that next 3 of our. If they say the deck needs some repair, do you need to get it right on that, or could you say, We can do that later.
No, you can do it later.
Yeah, so all of this is letting you know what the problems are, and then whose decision is whether you want to fix it or not.
Well, then it's our decision.
So now what am I doing? I'm saying, hey, if I show you things are wrong here, you'd be smart to fix them right now. Or am I saying, hey, all we're doing here is find out what is there any things that could be looked at, anything to be improved, and then it's up to you whether you want to do it or not. It's up to you what the timetable would be. It's up to you. It's up to you. It's up to you. All the research on psychology says that the more you say, hey, you're in the driver's seat, you make the decisions. I don't care how smart it looks on the outside. I don't care how many experts tell you you should do it. It doesn't matter what they're saying. You're in the driver's seat. You should be making a decision. You're the smartest person when it comes to your. When you tell them that, what happens? Does that work for you or against you when you tell them, hey, this is all, I'm here to just facilitate this. You're here to make the decisions. You may want to do this. You may not want to do this. What does that do to them? Again, it relaxes them. It makes them more open to making change. The more you tell them they don't need to, here's the weird thing about the psychology of the human being. The more you tell them they don't need to make a change, the more likely they'll make the change. And the exact opposite works as well. The more you tell them they need to make a change, what does a human being do? Even if you're in a theater, and the theater is on fire and somebody behind you is pushing, what are you going to do? Thank them for pushing you or turn around and do what? Even in a burning theater, you're going to turn around and push them back. Human beings, the more you tell them they need to make change, the less likely they are to do it. The more that you tell them, hey, the change is in their hands, the more likely they are to make change. That's what I'm doing here. So pay attention. This intro is not a throwaway. This intro is not a throwaway. It's laying the groundwork to relax them. It's laying the groundwork to set you up as a facilitator, as a consultant, not as a salesman. It's laying the groundwork so they feel like they're in charge, and when they feel in charge, they're more likely to make changes. This is not a throwaway part of the meeting. You should learn this part of the meeting as well, and it's super easy to learn.
And that's kind of how we're going to go today. We're going to look at these things, show you the problems, tell you what could happen. Are they immediate, or are they, in the future there'd be a problem? And then you decide at the end that what?
Oh, whether or not we're going to take care of it.
Does that make sense?
Yeah.
Seems like a fair way to go forward?
Yeah, sure.
Super. So the first thing we want to talk about.
So does that make sense? Do you see why we're doing what we're doing in the meeting? Instead of just jumping right into the information, we're laying the groundwork to relax them. We're laying the groundwork to make sure they understand that they're in the driver's seat, which it makes them more likely to change rather than less likely to change. And it's setting myself up as a consultant, not as a salesman. Make sense? Awesome. Well, thanks for being on today, and thanks for listening to our little pitch on why it makes sense to start to evaluate your clients' portfolios, and like Jerry said, be a fiduciary and at least show them what's available out there. And guys, don't throw away the intro part of the 21-point checklist. A lot of important things happening. So thanks for being on today. Have a great week, and we'll talk to you all next Monday. Thanks, everybody.